Is Toast, the stock, a good investment? I don't know. Let's find out. Join us over the next hour or so as Brian Stoffel and I research Toast stock from scratch. In this series, we take a stock that we've never researched and we're going to dig into SEC filings, investor presentations, Glassdoor, and we're going to fill out our investing checklist to find out if we think this is an investable idea or not. Brian, what is your current working knowledge of Toast?
Well, I like that you said that the stock is what we're talking about because the bread is always a good investment, in my opinion. So what I know is that it has to do with restaurants. I don't know much else, and I'm really curious because 3 years ago, I think it was 3 years ago, I was going to make an investment in Grubhub, but the deeper and deeper I dug into the company, the more I was like, boy, I don't know if there's really a moat here. And I think the time since then has made me feel pretty good about that decision. So I'm really curious to see if Toast is able to find a way to use this and be sustainable. So we'll find out. And I also want to say thank you to Graham and Justin who've just signed on to become members.
Awesome. Speaking of members, the reason we're doing Toast today is because of a member poll. So our channel members got to vote, and only our channel members got to vote, and Toast just inched out StoneCo in mode. So if you are one of our 107-ish or so members, thank you so much for joining. We plan to do at least 2, soon to be 3 member-only votes per month on what stock that we do. So if that interests you, click the join button. Brian, I know Toast a little bit. I dug into the S1 prior to the company coming public, so I know much more about it than you do, but I haven't looked at it since it came public. So let's get going.
Let's see. I'm curious. I love food, so
So we're going to go right to our checklist first. I will zoom in. It is a $53 stock. It's a $27 billion market cap. We're going to be
that's
filling
bigger
out
than I would
this
have
today.
thought.
The Feroldi quality score, the anti-fragile score. Is there any recurring revenue? I'm pretty sure the answer is yes, because this is a company that does software for operating a restaurant. Is it profitable, cash flow positive? Has it beaten the market? I don't know. It's
Was that
18%
chart?
off its 52-week high, and it looks
I
like it's
doubt that's beating
down.
the market.
Yeah,
Yeah.
probably not. All right, but this video is sponsored by stockcard.io, so we are going to start our search there. So we're going to go up to the stock card ticker search and do TOST. All right, we know that this is a 2021 IPO in the software infrastructure space. It's got high growth. So according to this,
Although in the lower left-hand corner there, it says it's underperformed the market there, the red X.
there you go. So it's been losing to the market so far, and they're reporting earnings on the 9th. Okay,
So they
Toast,
probably haven't reported yet then.
I would guess this is their first one.
Yeah.
Toast is a cloud-based, end-to-end technology platform purpose-built for the entire restaurant community. Its platform provides a suite of SaaS products, financial technology solutions, including integrated payment processing, restaurant-grade hardware, and a broad ecosystem of third-party partners.
Can I stop you for 1 sec?
Mhm.
What does restaurant-grade hardware mean?
I think the tablets on the tables for ordering and like the
Okay.
point of sale system.
That makes sense.
Some restaurants, like the host, actually carries around like a tablet for like dining and stuff like that.
Got it. Makes sense.
It serves as the restaurant's operating system, connecting the front house and the back of the house in dining, takeout, and delivery. Have you ever worked a restaurant?
I have not. I was an umpire and I did lots of mowing of lawns. That was when I was younger.
So I worked at a restaurant, the Ground Round, if anybody familiar with that.
Oh,
And I can tell
we've
you,
got those.
this was 20 years ago, when you went to the back and placed an order, we did it all on a point of sale system, and then it went and all the chefs had monitors, and that's what they were doing, and that's how you'd clear everything. So there is hardware in the space. So 24% revenue growth, 91% revenue growth estimated this year. It's not profitable. Let's see. They should have a good balance sheet. Free cash flow of $7 million is positive.
Wow.
In theory, we'll see that. and sentiment, consensus, etc. Okay, let's go up and head on over to Toast's investor relations website. Okay, so their call is upcoming. Our mission
Hey, all right.
to empower the restaurant community to delight their guests, do what they love, and thrive.
That's as good as it can get.
Yes.
Nice
Excellent job, Toast. Excellent job, Toast. Short, inspirational, optionable. All three boxes.
Yep.
Slightly too many words, but it's still that's something that somebody could memorize. Toast is the end-to-end platform built for restaurants of all sizes. Toast provides a single platform for software as a service products and financial technology solutions that give restaurants everything they need to run their business across point of sale, operations, digital ordering, delivery, marketing and loyalty, and team management. By serving as the restaurant operating system across dine-in, takeout, and delivery, Toast helps restaurants streamline operations, increase revenue, and deliver amazing guest experiences.
Well, they get points for that because I feel like I understand what the company does.
Okay, so we'll go into the most recent results. So they just came public in September. So that means we're going to go into the SEC filings, and we are looking for Form 4, excuse me, 424B4. 424B4. We got it right here, and we're going to click on the PDF. This is going to give us all of the post-IPO data on the company. Can you see that okay?
I can. That's good.
Okay, so they came public at 40. The price was for 53.
Yeah, I think so. So
that's what they IPO'd at. So good job, bankers. That's pretty
Yeah.
close to the actual price. They raised $869 million. The actual amount that they generated was 826, and there was all the proceeds went to Toast. None went to insiders.
All right.
Okay. Our mission.
2 for 2.
2 from Tower, the restaurant community to delight their guests, do what they love, and thrive. Company gets mission statements. Our first customer, we chose to go with Toast because we felt like they would actually listen to their customers and built a POS, point of sale for their restaurant. We are still using them 8 years later.
And for those who don't know, point of sale is what you use to put your credit card in.
Right, exactly. $494 million in annualized recurring revenue, 118% annualized recurring revenue growth, 48,000 restaurant locations, $38 billion in gross payment volume, 110% greater than annual net retention rate, and a $235 million net loss. That's a big number.
All right.
Especially when compared to that annualized recurring revenue.
So they're losing 50 cents for every dollar they bring in, more or less.
On a net income basis.
Yes. Okay. Yes, on a not in terms of what's going in the bank. We'll have to dig deeper for that.
Company is 10 years old. I wish all IPOs had this. A nice snapshot of their history. Rebranded, point of sale, payment processing, gift cards, and loyalty, kitchen display, online ordering, multi-location management, inventory, kiosks, APIs, menu management, labor reporting, Toast Go, Toast Takeout, guest feedback. So products coming along the way.
Yep.
And 1,000 customers in 2015, 48,000 as of the time of this recording. A letter from our founders.
Yay.
Running a restaurant is tough. It takes guts and determination to be in this business, a love of the rush, commitment to anytime shift, and an act for making magic from the chaos of a diner service.
Is that your experience?
Yeah, it's very chaotic.
Yep. All right.
Always running around. We started and I don't have to worry about buying food or managing people or hiring or anything like that. I just had to worry about taking it out to them and taking the order. We started Toast to make a restaurant work a little easier. We had a passion we take our passion for small business and build a technology platform for an industry that wasn't benefiting from the digital innovation of other industries.
So these aren't like restaurant experts. It sounds like they're more tech experts who found an industry where they could do good.
Reminds me of like Appfolio.
Yes.
Started a simple concept at a local restaurant over a shared meal. How do we build a mobile app that can streamline the payment experience at restaurants? We had seen untapped potential for mobile payments to transform businesses and noticed how hard the owner of our favorite local spots were working to make up for the shortcomings. Our first attempts failed miserably.
Oh, I love that. That's great.
It was too difficult to integrate with legacy systems. We didn't understand the immense challenges of running a restaurant, so we went door to door listening to restaurant owners.
That's
Rock
awesome.
explained how he worked at the back office until 1 a.m. every night running the day's reports from a clunky point of sale system because he couldn't access the information from home. So more than 10 different technology stacks. Working closely with all these people, we learned that existing systems sucked and we could come up with something better.
That's a great story.
Our
That's
vision
a great story.
was to build a scalable end-to-end cloud-based restaurant management platform that would improve the odds of success for the hardworking people who fuel this community. Along the way, we discovered the restaurant industry was lacking a true technology leader. To illustrate how large it is, restaurants often lag behind other industries to transition to modern cloud-based platforms. Even today, many of our favorite restaurants run on a combination of legacy on-premise technology, commodity payment processors, phoned-in ticket orders, and a stack of paper invoices. Structural industry changes like perpetually low profit margins, higher average failure rates, and high employee turnover make running a restaurant harder.
Buy all of that.
COVID-19, yeah. Order and pay, indoor dining, curbside pickup. Yep, a lot of innovations needed because of COVID-19. Worsened it. Restaurants should be able to earn a fair profit without high fees or commissions. They should have access to all this. Yep, we committed to vision for a decade. We've got fully integrated platform for point of sale, operations, ordering, delivery, marketing, loyalty, team management, financial technologies, and everything
That
they need
financial
to run them.
technologies, I think, is interesting because Brandon commented in our comment section and said the lending part of the business is fascinating to him. I'm curious to find out about that too. Like it reminds me of Shopify, how they start lending to merchants, especially during COVID, to make sure they could stay afloat.
Or it's like a purpose-built Square.
Yes.
Square also goes to restaurants, but this one is like purpose-built and it's more than payments. Okay. We've hired many of our first employees are former servers, bartenders, kitchen staff, or even general managers. 2/3 of our employees have worked in restaurants.
Skin in the game. Love
As a
it.
restaurant, we've developed deep empathy and understanding for our customers that inform how we build us. 48,000 restaurant locations, lots of support. Okay, commitment to success. We serve our customers, pursue innovation, built a world-class team. Thank you. Aman Narang, Steve Fredit, and Jonathan Grimm.
Now, I don't see any of them listed as a current something.
It's a letter from their founders.
No, but I mean like current CEO or CFO. I just didn't see that in there. That's all.
Oh, we can find that pretty simply. Governance, executive management.
Bridette,
President,
Narang.
co-founder, president, co-founder,
There we go.
CTO. So CTO, COO, president, but the CEO is somebody else.
Okay,
we'll
but
look
all
at
three
him.
are there.
We'll look at him later. Mission, 3 for 3. I wonder if you can get the trifecta and also have that on Glassdoor. We'll see. Okay, we saw all this, 48,000 restaurants across approximately 29,000 customers. So 48,000 restaurants, 29,000 customers.
So what does that tell you?
That means that the average average customer has 2 locations.
Right. And so we're
1.8 locations.
We're talking about mom and pops here.
Yes.
We're not talking about, they're not going to McDonald's or Chipotle. I mean, that was probably pretty obvious, but we know that.
The restaurant industry is large and complex. 22 million restaurants globally, 2.6 trillion in annual sales. They're behind on the adoptions. Technologies are legacy. They're not scalable, flexible, built specifically for restaurants. Okay. We started Toast to address the pain point. We've translated our love into a commitment to innovation. Okay. Restaurant operators. We arm restaurants with a wide variety of products and capabilities to address their specific needs, regardless of size, location, or business model.
We've covered a lot of companies recently, Brian, that are focused on the very small businesses. And it is a really good reminder that just because it's not McDonald's, Chipotle, whatever, If you cobble together all those small players, it's a big opportunity.
Huge. But you have to be willing to accept higher churn
Yes.
as a trade-off.
Yep.
Okay. We are laser focused on helping our customers deliver memorable guest experiences at scale, can place orders accurately, in person, across web, mobile, dine-in, takeout, and delivery, use their guest data to deliver targeted and personalized experiences with loyalty programs and marketing solutions. 5.5 million guest orders per day. Okay. 500,000 daily active restaurants. Employees are easy to learn, easy to use technology, improves the experience of 500,000 daily employees. Great hospitality. Okay. The benefits to all stakeholders use the Toast platform creates a powerful virtuous circle that amplifies our impact on restaurants. Guest satisfaction generates loyalty to restaurants, driving repeat sales, word of mouth referrals, and larger checks. This promotes employee satisfaction, helping reduce turnover, and motivates employees to continue to raise the bar and guest experience. Our integrated software and payments platform consolidates data to restaurant sales and operation, which enables our reporting and analytics, as well as financial technology solutions, such as working capital loans, to further support our customers' success.
Very interesting.
We're in the early stages. Location on our platform represent only about 6% of the 860,000 restaurants in the United States.
That's actually much bigger than I would have thought, that they're at 6% already.
Yeah, that's pretty decent market share. Scale was only about, our ARR was 3% of our total addressable market at $15 billion. We see a significant opportunity to increase sales, further expand our usage outside of the US, and address diverse and needs of restaurant stakeholders.
I can tell you from traveling abroad that that is an enormous opportunity.
Sure. 22 million restaurants versus only less than a million in the US.
But I even mean, from my experience in a lot of places, even the farm that we live on runs things like they could use this.
Oh, okay. Our gross payment volume grew 17% to 25.4 billion in December 2018. That number, not that impressive, but it also includes a quarter when restaurants were shut down. The 6 months ending more recently grew 125%. Okay. We generate revenue from 4 main streams.
Ooh, here we go.
Subscription services, financial technology solutions.
Really? All right.
Hardware and professional services.
What's
our revenue?
Okay.
I'm guessing that's implementation.
Yeah.
Our revenue grew 24% to 665 million in 2019, 823 million in 2020, and 105% in the year ago period to
the 6 months.
6 months.
Basically, the first half of 2021, it grew 105%.
Yeah. Okay. So their run rate for the year is 1.4 billion. Our ARR grew from 184 million to 326 million. Okay, we incurred a net loss of 209 million and 248 million, and adjusted EBITDA of 172 and 94. So net losses were very high. Okay, our industry, tons of restaurants. We're just a small part of it. GDP is huge, 860,000. Lots of problems. 53% of adults said purchasing food for takeout is essential to the way they live, up from 29% a decade earlier.
That's bananas. That's
Makes
crazy.
sense. In COVID world, lots of people only want to do takeout or delivery.
Yeah, okay.
70% of restaurant operators across plan to keep some of the changes they made to their restaurant as a result of COVID-19, even after the pandemic is gone. Sure. People want to eat different things. Yeah. We have the lowest industry is a laggard with the lowest level of digitization across all sectors. Spent 25 billion on technology, which is less than 3% of their sales. Okay. What it takes to thrive. The top challenging facing technology teams was feeling held back by legacy hardware. 59% of respondents said they plan to reduce the number of disparate technology systems to achieve their strategic growth.
And we've talked about this a bunch too. When you can build an umbrella that has all the tools where the end users are used to cobbling together all these different pieces, that can be a major headache eliminator.
Yeah. Huge switching costs then.
Yep.
Integrated payments, financing loans, bankings, takeout, first and third party delivery, payroll, benefits, scheduling, insurance, recruiting, wait lists, reservations, supplier management, scan to pay. Yeah, lots going on. Gift cards. Okay. Restaurants are complex. They must improve operational efficiency. Restaurants faces a number of operational challenges, including high cost, resulting in typical operating margin of 4 to 5%.
See, that's
Yeah.
the crazy thing. If Toast is able to shave off 1% of the operating costs, profits could go up 20 to 30%.
I wonder if that's part of their pitch.
I mean,
Deliver
it better
omnichannel
be.
experiences. 40% of food service will be from dine-in, 51% will be takeout, 9% home delivery. Personalize the guest experience. When an emotional connection exists between a restaurant and a guest value can increase as much as 27%. 51% of restaurant operators named hiring staff as a top challenge.
I bet it's even higher today.
Yeah, definitely higher today. Collect and leverage data. Data and analytics can yield a 5 to 7% increase in revenue, 10 to 15% reduction in operating costs, and 10 to 20% improvement in earnings, EBITDA. So there you go.
That's it.
Increased access to financial services. By payments, Main Street will have only 24 days of cash buffer in reserves.
I buy that. That's
Okay.
totally believable.
Current technologies are inflexible, not purpose-built, bad at onboarding. So our platform, subscription services, point of sale operations, marketing, loyalty, team management, financial technology solutions, integrated payment processing, financial technology products like capital and financing, platform reporting, e-commerce, and API and partner ecosystem.
Interesting. Okay.
Single platform that does all of that, plus APIs. Okay. Toast ecosystem, happy employees, make happy guests, make restaurants successful. Okay.
It's funny because we usually see a flywheel like that to prove the network effect, but what they're really proving here is high switching costs.
Yes. Yeah, exactly. They're not saying, yeah, I wouldn't buy the network effect.
No, I wouldn't either.
Okay.
But I will buy high switching costs.
Yeah. So we do all these benefits: onboarding, access to capital, driven by our mission. Cool. So our opportunity, huge. There is no leader. Toast is trying to become the leader. $15 billion TAM. Yeah, it's just, we estimate Toast capital opportunity by multiplying 29 billion of outstanding U.S. public bank restaurant loans by the average interest rate of 1 to 7%. Okay. How to grow: new customers, existing customers, upgrades, expansion, partner ecosystem. Toast integrated SaaS platform currently connects customers to 150 partners, providing them with tools and features they need to run their business. Continue to expand our technology and our partnerships to deliver even more value.
I want to know more about that because there's a weak network effect that could come into play.
And I'm sure we can find that on our website. Expand internationally. We have not made any significant investments in growing our presence internationally. We intend to add international sales teams members to address this opportunity.
That's going to be expensive.
Yeah. We rolled out new products in response to COVID-19. Toast Now to quickly ordering gift cards. We waived subscription fees of over $20 million to our restaurant base.
Good for you.
28 point, yeah, restaurant relief. Risks.
Everything
we just said is incorrect. Common stock after the offering. Okay. Total class net. So 500 million shares.
Mm-hmm.
Use of proceeds.
I'm curious about that. We've seen a lot of
increase our capitalization, increase our financial flexibility, create a public market, and enable access to public markets.
Huh.
So nothing for
I want to see that balance
working
sheet
capital. Then. Yeah. Voting rights. We have two classes of stock, Class A and Class B. Class B, 99.5% of the voting power. There you go. Concentration of ownerships. Our executive officers and directors will own 15% of shares outstanding and 99% of the voting.
That just took care of one of the things I needed to know.
Yes, it did.
But I'm curious. I'm still curious who it'll be too.
Okay, so let's look. Here we go for revenue. So in the 6-month ending 2021, total revenue 700 million. Financial technology was the bulk of it. 579 of the 703.
But also, it looks like it's not the lowest margin, but it
We'll take them one at a time.
Yeah, okay.
Subscription services, AR, it was $68 million. So what's that? $130 million in annualized revenue from that. FinTech, financial technologies, was 579, and the gross margin on the software is 70%.
Yeah.
The gross margin on the FinTech solutions
20?
was 25, something like
20,
that.
25,
The
which
gross-
isn't bad off such a big number.
The hardware is negative gross margin.
Mm-hmm.
The professional services is hugely negative gross margin. And amortization of acquired technologies. So their gross profit is $154 million. So 154 divided by 704. So their consolidated gross margin is 21.8%. That's pretty low. 449 divided by 343. And last year it was lower. 449 divided by 3438. Their gross margin last year was only 13%.
Well, so it's
now
expanding quite rapidly.
Rapidly, yeah.
What I will say in looking at these numbers is that even though the fintech solutions are so low margin, that volume is jaw dropping.
Huge.
And I would say
growing fast.
The other way to look at this too is that the subscription services are a flat monthly rate, I'm guessing. Like obviously you can upgrade and put new things in there, but my guess is since payment processing is a big chunk of that financial technology solutions, that is usage based. So we're marrying together a low margin usage base with a high margin subscription base. And do you know what that reminds me of?
Shopify. Okay.
And people always they gave Shopify a tough time for that. But when you're dealing with that big of a number, close to $1 billion annualized, it's okay if it's low margin.
Well, so gross profit tripled from to 154 million, and again that's 6 months. So annualize that, 300 million in gross profit. Now, half of that goes to sales and marketing, which is the biggest expense. The second biggest expense is research and development. The third biggest expense is overhead costs, but 56 million in loss from operations.
But look at sales and marketing from last year to this year. And
flat.
I realize, stuff was happening, but still.
Yeah, flat. Okay, so their loss is roughly $100 and something million per year. So all of this stuff, look at this, is fair value and derivative liabilities, fair value of warrant liabilities. So all this is financing stuff. So their net loss of 234 million is closer to this than it is to this.
Yep.
And I'm guessing their balance sheet got cleaned up as a result of the IPO process.
Hope so.
Yeah. Okay. Pro forma weighted average shares. It was like 500,000. Okay, balance sheet.
There we go.
So pro forma as adjusted. These means what's their IPO. This is what their balance sheet would have looked like if they IPO'd before June 30th. So 1.2 billion in, 1.1 billion in cash. Total working capital of 1.5 billion. Total assets.
No, it's total assets of 1.
Oh, I'm sorry. Okay, I'm looking at the wrong one. Yeah,
I did the same thing.
Warrant to purchase converted stocks 20 million. Warrant to purchase common stock 125. Total liabilities, so no debt, of 455 million.
Well, there might be debt.
Convertible preferred stock, additional paid in capital. No, I don't see any debt.
Well, I just don't think it's on there. I don't think they've called it out.
You're right. Gross payment volume up huge. Annualized recurring revenue up huge. Okay. Free cash flow positive.
Really? Oh,
39 million.
39 million in 6 months.
And adjusted EBITDA of positive 14. Free cash flow is defined as net cash used in operating activities reduced by purchase of property and equipment.
Yeah, so
And
that number is probably right.
capitalization of internal use software. So they're also including software in there.
But so trailing 12 months, it probably is what Stock Card said, around 7 million, because it was
70
negative
million, yep.
106. No, 7, because it was negative 160, and then it improved by about 170, 167. So that's probably right. They
roughly
just
break
broke it.
even, but
Yep.
they're profitable on a free cash flow basis. Yeah, another reason why I had to learn the difference between free cash flow and net income. Okay. Let's do concentration.
Oh, there can't be any.
Yeah, I can't imagine either. No customers for more than 10% of sales. A single third-party automated clearinghouse acquired that represented substantially all deposits. Okay. And just ownership. Speaking of which, let's see. It's like principal.
Beneficial is what always gets me there. The word beneficial.
Beneficial.
Yeah, you got it.
Get me spelling things correctly.
Hey, you're doing it live in front of tens of people. That's brave.
Okay. Executive officers. So the three guys were Amon. Yeah.
And
for debt and
Grimm. I don't see Grimm in there.
Yeah. What's the CEO's name?
The Comparto. He's the one at the top.
Chris Comparto. So he got 2% of the business. Class B as well.
But these other two own a sizable
Bessemer Ventures. That's a name I respect. Jonathan Grimm.
Oh, there's Jonathan Grimm.
Yeah, he's here. 5.8. So, yeah, insider. I don't know why he wouldn't be counted as an insider.
Yeah, it said he was a president and a board member.
Yeah, he's not up here though. Oh, he's just listed there, I guess, because he's a 5%. Yeah, so 18% inside ownership, roughly.
That's great.
Yep, times a big number.
26 billion.
Okay, so let's go to their website and look at the integrations.
Yeah.
Hardware, 40,000 restaurants have outperformed their peers by 10 to 30%. So that's low-cost delivery. Reduced third-party delivery commissions by up to 80%. Commissions.
Yeah, but 80%, that's a huge...
Contactless ordering. Handhelds. Online ordering.
A number of people in our comment section say that those handhelds are top of class.
Okay. Good to know. Pay as you go. 1 to 15 locations. 0 upfront costs for that. And enterprise, 1,600. Our turn times dramatic, equating to an extra 500K per year. These are big names. Harpoon Brewery.
I know Harpoon.
Me too. Let's go with Toast Software. Toast Now, set up digital channels. Online ordering, Toast delivery service. No drivers dispatch local drivers through an on-demand delivery network. Toast order and pay, marketing. Yeah, they seem to do everything that integrations. Here we go. Toast integrations, Staples, Davo
for accounting.
Okay, Rome, DoorDash, fulfillment, takeout, and delivery orders just got easier. Integrate Toast and DoorDash. Pop menu, eCard.
I wouldn't necessarily say that these integrations create a network effect.
ServePro, yeah. I wonder if they have a Grubhub. So those would matter, right? Those would really be like Olo.
So can you tell me about Olo?
Olo is OLO, online ordering. It's a system that allows a big name restaurant to essentially order the same software that like Grubhub has, that DoorDash has, so that way you can handle all of that on your website in your app, as opposed to being forced to rely on a third party.
Got it.
Open Table. All right, so they do have some integrations.
Right. I'm
Okay.
not sure that would help build a moat. It's very convenient, but
Fair point. All right, let's look at this guy. He's a CEO, high growth SaaS, prior to joining Toast. When he joined, when did you join? Favorite toast, Italian.
nice.
Oh, let's go to his LinkedIn page. When did you join?
He's been there for a while.
2015.
All right.
7 years. So he's been there a little while.
Did it say where he was before?
Some and Deca. Do you want to go back? Where he came from?
Yeah, I'm just curious.
Acquia, SVP of Customer Success, and Deca, which was acquired by Oracle.
Okay.
Yeah. Okay. These guys.
Hey,
CPO.
I know Elena Gomez. She was at Zendesk for a long
Zendesk.
time.
Yep. CFO.
And she's on a lot of boards too.
Accomplished executive right there. Okay. Anything else you want to check? Glassdoor. Toast. Okay. Top CEO, number 51.
Hey.
That's cool. Mission. We are a rapidly growing company. Fail.
Wah, 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 wah.
Nah, you still get it from me for doing everything.
Oh, they'll get it for me too.
So we just click on reviews. 582. 4.2 stars, 95% CEO approve rating, 80% approved to a friend, and he was one of the top CEOs of 2021.
Oh, I know one thing I'd like to see is a balance sheet.
I think we just got the consolidated one, right?
Yeah. So I'm just curious if there's some debt in there.
Well, so this is pre-IPO, so this is not.
Oh, it doesn't have like
it doesn't have a
pro forma.
Yeah. It said, so this is pre-IPO. Long-term debt was 37 million. No,
171.
171 million. Either way, they have 1.1 billion in cash.
Yeah, so it's pretty small.
And that's assuming they didn't take that out.
Mm-hmm.
Yeah. So their total liabilities were 400 million.
There's one other thing I'd be curious about. Can you go to the cash flow statement? Because I know they were super negative before, but I wonder, did they just cross over or did they go super negative? We won't find out because they only give us 2 years.
This is year ending. Yeah. What are you looking for?
So I was just curious if maybe they were super negative because of COVID, but they were positive before, but it looks like that was not the case.
Not the case.
No. So they are literally, they just crossed the threshold.
Right. But they're there on a free cash flow basis.
They're totally there.
And their stock-based comp in 2020 was 86 million versus how much in revenue? 800 million. That's less than 10% of revenue, more like 70% of gross profit. But I think I'm ready.
Yep, I think I am too.
So this is a no. This is a yes. And this is a no.
No.
All right, so let's go. Oops. We've done a bunch already.
A lot of reviews.
10, 28, 20, 21. Okay, balance sheet. I'll go 5. Tons of cash, little debt.
Yep.
Gross margin, under 50%, well under. Very low gross margin, but it is rising fast, so you get 1 point. Returns on capital will be negative. Free cash flow is positive and growing fast. And earnings is not negative and will be for a while. Okay, moat. Is there a network effect or a product ecosystem? There's a little bit of a product ecosystem, but that's on the hardware side.
Yeah.
And will that convince people to buy more products? Not really.
I think that's more switching costs than it is
but I will go full credit on the switching costs.
Oh yeah.
Once you get this in, good luck getting it out. It's your everything. So I don't think they have a scale distribution or vertical integration. They might have a brand, doesn't matter. Do they have counter positioning?
So maybe, but the thing is,
Maybe.
the thing is that if it's true that everybody is using a hodgepodge of plugins to make things work, you could argue that this one plugin is not going to spend hundreds of millions of dollars to develop enough solutions to challenge what Toast has.
I was just thinking like against a Square, like Square makes the hardware, Square has the software, Square has the lending. So they don't really, if Square didn't, if like competitors like Square didn't exist, I would say yes. But for right now, I'm going to say no.
Yeah.
And they're rapidly expanding. I'll
Mm-hmm.
give you full credit. Optionality, lots.
Mm-hmm.
Fintech and all that, all within the restaurant industry, but clearly signs of willingness to roll out new products and new services. Growth runway, very high, 4 to 4. Are they a top dog and first mover? I would say, I'm guessing a disruptor, but man, they're doing that well. Do they have operating leverage ahead? Yes, because they're still losing money, but their gross margin does put a cap on that. But small changes in margin will result in big changes in there. So I'll give you full credit for operating leverage. Okay, customer acquisition. It was about half of gross profit, right? Spending on was about half. So I'll go
about half.
2 there. Once they're on, are they dependent? Yes. Okay. Is revenue recurring? Some of it.
Well, I think all of it is.
Well, professional services, hardware.
Yeah, but those don't even bring in any money for them.
Yeah.
Like
I'll
in
give
gross
them a 4.
profit.
I got a 4 on that. Pricing power. Can this company raise prices? I'll say yes.
I think so.
3.
If you get, I mean, they're in the growth stage now. Once they're out of the growth stage,
yeah. Soul in the game, 4 out of 4. Inside ownership, 3 out of 3. Glassdoor rating, 4 out of 4. Mission statement, 3 out of 3. Performance since IPO, it's still very early.
Yeah.
Are they doing anything versus their shareholder-friendly actions? No, but they don't have any capital to do that. And then are they doing versus expectations? Don't know yet. It's too early. 74.
No, and let's point out,
score.
A year from now, if they got all 3 of those, that could be as high as an 85, assuming everything else stays the same.
Right. Okay, bad stuff. Accounting regularities, no. Customer concentration, no. Industry disruption, no. Outside forces.
Yes.
Yes?
A little bit. Well, because
they have COVID.
They did survive COVID. It's just because that usage base is in there. But I don't know.
That is more about if interest rates rise, will it matter?
Oh,
no.
Well then, yes.
If commodity prices change, will it matter? No. If the stock price declines, will it matter? No. If the economy goes the other way, will it matter? No. Big market loser, not yet. Binary event, nope. Extreme dilution, we don't know dilution yet, so that could be a negative. I'm not going to knock any points off yet. Growth by acquisition, partially, but not really. Complicated financials, antitrust, headquarters, and currency, nope. 74. I'm saying I'm going to put it in the thumbs up portion of my portfolio.
Oh, yeah. You got to.
Okay, Brian, your turn.
All right. So I will just say I'm excited about this. This is very interesting to me. So mission statement, 2 points. For the moat, I'm just going to give them points for the switching costs, so 2 points. I will say that I could be convinced that there could be a little bit of counter positioning there, but I need to learn more. I'll give them 2.5 if that's possible for optionality.
It can be.
Nice. Look at that. And I will also say I'd be willing to bump that to a 3 because what has been clear to me in reading our comments and in reading the company story is that payments was why this company was created, right? Like they wanted to fix payments, but then they realized there are all these other things that they can fix. And from our comments, their payment solution is like top notch. It's the best in the industry. If they can do the same thing for all these other areas that they did for payments, I would up that to a 3.
Okay.
So plus full point for this, their financial fortitude, no concentration risks.
Okay.
And a point each for all 3 of these because Glassdoor, founder, ownership are all good. You've got a really good score here.
That's a 10.5, Brian. That's a 10.5. So again, as a reminder, on the scales. Let me zoom out of this so people can see. So for me, it was a 73, which is investable and with upside to the 80s. And for you, 10 and a half. So for you, that's in your robust category.
Yeah, and
All right.
it could go into that anti-fragile territory
So we're going
soon.
to put this into Brian Stoffel's thumbs up portfolio, which is his anti-fragile portfolio. So we're going to do a new order on stock card. We're going to buy it as of today's date. It's 52. So we're going to buy that 19 shares,
Yeah, it's probably 19.
19, and it was a score of 10.5.
Yep.
Cool. And then we're going to give it the thumbs up in my portfolio, which is Brian Feroldi Quality Checklist. We're going to do TOST.
And while Brian does this, we're just going to point out that you can go to stockcard.io and view these portfolios for free. But if you want to start making some of your own, you can use the code antifragile to get a discount on becoming a member at StockCard. And you can keep your own portfolio. You don't have to use real money to do it, but it's a great way to learn. We're not going to take our returns too seriously yet because we've only been entering these scores for a couple of months. But a couple of years from now, we're going to learn a lot from these things. So head on over, set up your own portfolio so that you can start learning with us and hopefully start outperforming us as well.
That's right. Question here. Can I align my camera vertically? Sorry if it wasn't out of line. Yes, it was a little out. Shame on Brian Stoffel for not pointing that out. Thank you. Dave says, Olo is another interesting play in the space. Yeah, Olo is a stock that I own. Online ordering. Very impressive company, too. Brandon says they have paid off their debt. Dave Drum is intrigued by the subscription and the recurring fee. First-hand experience here from Michael Martinez. I use them. They are a pain with the new update, but they refuse to fix it.
So one quick thing about that, I'm not sure, and maybe Michael, if you're still watching, you can let us know if he was talking about Toast or Olo, because someone in the comment section had just talked about Olo.
Oh, okay. Speaking of Olo, is Olo a competitor or a different part of the business? So Olo would be a complementary product, slight competitor in some ones, but Olo is going after the enterprise grade customers. So they're going to like Darden and they're saying, hey, roll out this solution across your entire network all at once. So that's one reason I like Olo, or that's one plus or minus to Olo. Olo spends very, very little on sales and marketing, and it's also profitable and founder led. But we could do a deep dive on that one if people want. So Brandon, great. Their hardware is exceptional. Brandon is our toast Sherpa. Thank you. Great. The lending part of the business is fascinating. We've used it for a lot of years. The valuation is crazy. I'm guessing it has been.
I mean, to remember in that, we were talking about a company that just crossed the threshold to free cash flow positive. So no matter what, it's going to look crazy.
Yep. And we made a video on valuation if you're interested in checking that out. All right. Thanks so much. So yes.
One last thing. Michael Martinez said that he was talking about Toast. He said when traffic gets super high, it can create problems.
Oh, okay. There you go.
So good to know.
Thank you all so much for watching. We hope you enjoyed that. And if you are interested in voting on what stock we do next week, check out our YouTube channel page and consider becoming a member. Thank you that everyone has done that so far. Brian's out.